Yeah.
Get out there, meet people, learn what's going on. It's not just about networking. It's not just about grabbing 10 business cards at an event. Find one person that you can actually partner with, whether it's a limited partner who wants to invest in your deal, whether it's an active operator, you want to invest in their deal. Because whether I invest actively or passively, I learn something from every single deal I'm a part of.
Are you looking to achieve massive success in your life without dealing with costly investment nightmares? If yes, then this is the podcast for you. Here, we provide engineers and busy professionals all the secrets and strategies to create multiple streams of income, build generational wealth, and live a meaningful life by design. Here's your host, Ted
Hey
Patel.
everyone, this is Ted Patel, and welcome to this week's edition to Decoding Cash Flow Podcast. Today, we have a great guest, George Roberts, who is a commercial real estate expert and brings a unique perspective to this industry with a background as an award-winning data scientist and nearly 800 scientific citations. George has transformed his analytical expertise into actionable insights for real estate investors. And today, he's here to share his journey and investment strategies. So, George, welcome to Decoding Cash Flow. It's a pleasure having you here on the show.
Well, it's a great pleasure to be here, Ted. Thank you for having me.
All right. So, George, before we get started on, discussing about your niche, what you do right now, if you can give listeners a little bit background about yourself. What did you do before joining to real estate? When did you join real estate investments? And what's your current focus as of now?
Well, so many things. Which would you like to talk about, Ted? So
Let's go all the way
I was a
back and
bioscientist. I
yeah.
published in three fields. I realized time to update the biography. We finally exceeded 800 citations last year. Went into data science, thinking that just working at a company versus being in academia would be the freedom I sought. And it was to a degree. But when I realized how beautiful it was to be an entrepreneur and literally chart your own course, I love sailing analogies. I am a sailor. And the feeling to literally be, the captain of your own ship. I realized that it was worth the effort one day when we had a Saturday morning business meeting. This was the construction company that we launched, and we were there until it was dark.
Hmm.
And that I didn't feel tired at all. That was so different from my technical job, which I loved, but could never love as much as entrepreneurship. So from that point on, that experience truly changed me. I realized, hey, it's one thing to be talented technically, but that doesn't mean that you need to stay in tech your entire life. And at that point, I was already a single family landlord. I guess I'll let you pick it up from there because essentially I realized that I do understand business. I already have a business, which is being a landlord, and I decided let's just do it at scale.
Hmm. So you worked as a data scientist, right? Earlier at the stage. What was a pivotal moment or a point or trigger, I would say, which sparked your interest in the real estate, frankly speaking?
Yeah, so I had already been in real estate before that, but I
Hmm.
really just stuck my toe in. So I was an accidental landlord, couldn't sell my
Hmm.
home for much in the depths of the Great Recession. So why not hold on to it and get a little cash flow
Hmm.
while the home reappreciates back to what it would be worth under normal market conditions? Well, I really went in search of the very, very best place to invest my money. And I
Hmm.
decided in 2020 that it would be multifamily real estate, and specifically that we were going to invest in Orlando, Florida. And
Okay.
those were two great decisions. So
Hmm.
essentially, I was using the skills that I had on the job, using that analytical firepower, and saying, hey, why don't I take my own capital? Where would I put that? Where would I be if I wasn't working at this company?
Hmm. And this investment that you're talking about in Orlando, right?
Mhm.
How did you came across that investment?
So the same way everybody does, we
Uh-huh.
were vetting deals every week, couple a week, months and months and months.
Uh-huh.
And you got to say no 100 times at least, or at least that's how it was in 2020. Some people say it's gotten worse, maybe a little bit better, but I've
Mhm.
also heard people say they say no 300 times
Mhm.
before they say yes. So after probably 100 no's, we found one where there was some seller fatigue. And that deal fatigue, after a couple deals fall through, the
Mhm.
seller really just wants to be on the other side, whether it's a different venture or just to stick their toes in the sand. And
Mhm.
we were finally able to get a good deal. It was also during COVID, right? People were afraid to
Yeah.
buy, and it wasn't entirely clear that another great buyer was going to materialize. So we made a little bit of a lowball offer. We got our first deal, and it worked out.
Mhm. And was it with the partnership with anyone? Like, how was the project structured?
Yeah, so it was the same partners that I was vetting deals with every week. We
Uh-huh.
formed a sort of a mastermind.
Okay.
I would say there's many different ways you can do it. I mean, you can kind of sort of try and go it alone, don't get a mentor, form a mastermind with people that are at or around your level, or you can pay somebody a lot of money and, hope that they bridge you to that first deal. Well, I did it the former way. I just found people that were interested in vetting deals. These are people who had financial savvy. They were in real estate before, like
Hmm.
me. Uh, find people like that, partner up, and you can do it. You don't really need to go pay a guru tens of thousands of dollars to get into the business.
Yeah. No, that's what I also, that's my philosophy also, and that's what I tell my listeners. If you want to get into some niche, like any kind of business, right? Uh, Instead of you jumping alone in that business, just team up with someone who is already in that space. It
Right.
will just reduce your learning curve by 1/10, you know,
100%.
and
Yeah.
and you learn from his mistake instead of you doing your own mistakes.
My favorite
Yeah.
quote. Yeah, the
Yeah,
wise learn from the mistakes of others.
exactly. Exactly. All right. So this deal in Orlando, right? Were you a limited partner, general partner?
Yeah, so we were
What was
general
the?
partners, three of
Okay.
us, or I should say really joint venture because of no
Okay.
syndication. So
All right.
simple
Mhm.
structure.
Okay.
And it's a great way to begin.
Yeah.
The other question you have is whether you go big or not. Well, I would say, look, if you buy 14 or even if you buy five or even two, three, or four for your first or second or third deal, you're already outpacing most other people who are just buying one at a time, which is fine.
Yeah.
Being a residential landlord is a perfect way to go. It's wonderful. But you don't have to go and buy that 100 or 200 unit apartment your first or second or even your 10th time out. Just start a joint venture with some of your friends who are interested. We had our cost to get in, all in was about, I think, $270,000. Three of us, $90,000 a piece. All
Mhm.
in all, that investment just to get into it was not much more than if we'd gone and bought a single family home, for example, perhaps even
Mhm.
cheaper, depending
Right.
on what market
How
you're
many
in.
units were there?
14. So
14.
yeah,
Yeah,
I
not
mean,
bad at all.
so yeah,
Yeah.
when you talk about size, I mean, some people say, well, I buy 100 or 200. That's beautiful. If that's what you do and you're successful, I love it. But that got me into the business. And again,
Mhm.
I didn't need to go pay some great big guru. And after that, I had a credibility and I started to get into syndications the next year. First as a co-GP and then as a general partner. And then that's one of the things that I do now.
Awesome. All right. So you just focus on the multifamilies as of now, or is there
Yeah,
any
so
other
you do
assets?
have to stay in your lane. You
Yeah.
mentioned like how do you get into something? Well, partner up, find somebody who's done it.
Yeah.
Uh, that worked for me. The other way to do it is if you're investing passively in something, right?
Hmm.
A lot of times I'll invest passively in something. It's a great way to dip your toe in the water. I haven't really changed my MO yet, and I may never, but it's a sort of a semi-safe way of getting to learn about something. That's another way that you can expand your wheelhouse. So yeah, for me, when it comes to operations, it's
Hmm.
strictly multifamily. Stay in your lane.
Okay. And how do you think, like, your background as a data analyst, how do you relate your old background with what you're doing right now? How does that help you in the real estate?
Well, I think that you really got to understand the numbers. Whatever you're
Yeah.
doing, dive into the numbers, understand the business end. And the fact that I'm willing to go and do uh, original research on companies and in real estate, I think it really helps me to see things differently. Also consider that we're all storytellers. I mean, if you want to you want to work with other people's money, you want to raise capital, you've got to tell a story. And the one thing that working with numbers taught me is that at the end of the day, you really have to be that storyteller. I mean, you figure ever since people have been writing in chalk on cave walls,
Hmm.
caveman times, we're really storytellers. So learn the numbers, find the story behind each deal, and then go out and tell that story.
Yep, that's good. And any specific criterias right now you have when you invest in any deals as a
Yeah, for sure.
syndicator, like, area wise, geography, location, population, employment. What is the special thumb rules that you use normally?
Okay, good. Well, I think first of all, I will say two things when it
Mhm.
comes to investing. If I was going to sum investing up in three words, I would say margin of safety. So, what is my first criterion? I like to see that rents are under market as is. So, if the entire business plan fails, I want to know that we're okay, we can hold on to the asset, and hopefully even simply raise rents to market and provide some return for the investors. Now, second, you asked about market, and that's a great time to be a contrarian because a lot of people will tell you, look, I invest only in the major metros. I like Atlanta, I like DFW, and that's
Mhm.
fine. I started out in Orlando, just out of the south of the city proper, right next to the city center, just a few minutes from downtown, and that's fine. But I've also found there's a great niche in these tertiary markets because it's a lot less crowded.
Mhm.
And when you do have the power of the numbers and the willingness to go in and analyze, you can build the sort of mental toughness that allows you to stick it out in places where other people aren't looking. So if you do want to look for the 100 units and up in the major metros, in the hottest markets, have at it. But I
Mhm.
found in my life that it's always worthwhile to go and find a somewhat less crowded playing field. And
Yeah.
when you do that, you can become much more successful. So out in those tertiary markets, we find that a lot of times you can get an asset that's been held for 10 or 15 years. It may have no debt on it. You have a seller who may not be desperate to get, this super high price. They may have already doubled or tripled their money.
Mhm.
You may find somebody who's willing to make a deal because they really haven't optimized their asset. When assets change hands every 4 or 5 years, as they do in a lot of these major metros, it's really hard to
Yeah.
operate better than the last
Yeah.
owner. And
Every
again, hey,
penny is
if you want to
squeezed out of it by the operator,
exactly,
all
if
the
you
time.
want to
Yeah.
go and ring that towel one more time and you say, hey, I'm super macho,
Yeah.
I can do it, I can still, get a few drops out of this, go ahead. But I'd rather go to a market where I think it's less saturated.
Mhm. Okay. And with regards to underwriting a deal, right? Let's say you got a lead from a broker. Um, what are the things that you will look at while underwriting that deal, just to make sure it fits your criteria, it doesn't fit your criteria?
Yeah, well, so the first thing is market, submarket, and neighborhood. Do I like the neighborhood? Because if I don't like the
Uh-huh.
neighborhood, forget it. I'm not going to
Hmm.
go crunch all those numbers. Second thing I'm going to look for is below market rents. Sure, I'll take a quick peek
Hmm.
at the comps provided. But usually there are two that are a little bit nicer than the apartments
Yep.
in question, and three that are way nicer. So I don't usually get great comps from, yeah, I would go to apartments.com, go to any of the rental websites, go find a close comp of the apartment you're looking at. And if you can't see that, first of all, that the rents are maybe slightly below market and that renovated units are doing a whole lot better in that
Hmm.
market. I mean, as you see, I do apply a value add strategy. If you don't see those two things, then I don't really think I want to read the OM. I may glance
Hmm.
at it. Did the broker put together a good story? Now there might be a great story. But if it gets to the OM, it's probably not the story that the seller is tremendously distressed and that you're getting a great per unit price. So, what I would say is one of my main rules in investing is triage. Triage, always triage. You can't spend the appropriate amount of time on the investments that you follow through with if you're not immediately eliminating 90% and then very quickly eliminating about 50 to 70% of the rest. So triage as quickly as you can and then focus very, very deeply on those few where the comps actually do support an investment.
Hmm. And okay. So
By the way, I
anything
would say
like.
that I do focus on the comps because I think that's the one thing that brokers do the worst, and it's the one thing that syndicators do the worst. If I get a passive investment across my desk, and the first thing I'm going to do is look at those comps, and usually I swear they've got to be the same ones that came from the OM because they're just ridiculous. They're completely cut above the property that's being presented. And if I can't find appropriate comps and say that it's still worth it, why would I dig through 300 numbers and validate all that? Forget about it. It's not worth the time.
Hmm. Okay. All right. And uh, in your business, right? Are you mainly focused on investor relationship, or do you do asset management, or uh, what particular aspect of this whole real multifamily real estate do you focus on?
So I do a little bit of everything, particularly for the joint venture, obviously, with three of us. We're all
Yeah.
asset
Yeah.
managers.
Hmm.
But what I do more than anything is connect people. So I like people. I like
Hmm.
making deals. I like bringing deals together.
Hmm.
So a lot of what I do is I'll talk to newer investors. They'll bring the deals to me. I can sort of vet the deal. I can help them with, I mean, obviously I'm a numbers guy. I can look at the underwriting. If it's something that I think is worth moving forward, I can make the introductions and then move forward. So for me, what I would say that what I really focus on is the deal making because that's what I like. It involves people and it involves capital markets.
Yeah. And as you mentioned, deal making, right? So uh, you source the deal from the brokers, or some
I'd
another
prefer to have someone else
operator,
source
or
it.
some,
Yeah.
yes, some
Yeah,
other
because you know
operator
what
will
you're going to
bring you
get
the
from the
deal.
brokers. Yeah, I've got
Yeah.
to say no to that, 100 times. But
Hmm.
if I'm looking at deals that at least, even if it's a newer investor, they're going to
Hmm.
at least filter out the obviously bad deals. And then at least when I have to tell a person, hey, I don't think this is a deal because it's at least a little bit more interesting because it's something that at least passed the first filter.
Hmm. All right. And when you say investor brings in the deal, who are these investors?
So I do a lot of media events. I have
Uh-huh.
local events. I do a lot of podcasts. I've got my own podcast. I've got a weekly
Uh-huh.
networking call. I've got a
Okay.
book. Uh, you can see that I'm quite active.
Hmm.
And so this presence helps me to source deals from elsewhere.
Hmm.
So, at some point you
Yeah.
have a choice. Do you want to go out and create value for others so that others bring value to you? Or do you yourself want to be the thin edge of the wedge? Well, I decided that if I want to do this with any hope of being passive at some point, that I have to let somebody else go out there, be the thin edge of the wedge. And then, somebody else who has a lot of hustle and maybe not a whole lot of capital, they have the opportunity to enter the business with me.
Okay. I think that's a good strategy. You get a deal flow from people who have already vetted the deals from their
Yes.
end. And if it works out, if it pans out from your end, then what would be the next step?
Yeah, like I said, just make introductions because I don't really want to necessarily run every deal,
Hmm.
or if I can get out of it, I don't mind dealing with capital markets, for example. It's a lot of work to get a loan. It's
Yeah.
crazy, or at least it can be.
Mhm.
Having passed that hurdle, that's another huge thing I can do. I have net worth. I can sign on the loan. I can find operators in a market. And, hopefully these are people I've at least invested with passively before. So I know that it's somebody that I trust. And I just leverage that incredible network that I've built up.
So if I understand it right, what you're saying is if one of the person in your network brings you a deal, if it pencils out, if it's a good deal, you feel like you connect with different people, maybe another investors, other operators, if they are interested in pulling the deal together, then you work with with your investors as well as the operators to put the deal together and close on them.
Exactly. Yeah. I'd prefer to be more on the intake than on the asset management. But again, I do a little bit of everything.
Okay. All right. Now, talking about syndication, you did mention you also started syndication before a few years. Can you give us a little details on how did you get started in the syndication, right?
Yeah.
Because now the first deal that you did, it was a joint venture deal. The second
Right.
one, syndication. So what was the process? What steps did you take to get to that level of syndicating a deal?
Right. So perhaps a rather different approach.
Yeah.
At the time that I entered syndication, I was in Yona Weiss's LinkedIn challenge. I met a lot of amazing people, and if you do this challenge, you'll get to meet about 30 great people and get to know them by the end of the week quite well, or end of 2 weeks, actually.
Uh, can
So
you repeat which challenges was that?
yeah, Yona Weiss. So Yona Weiss,
Okay.
he does cost seg,
Okay. Okay,
but
got it. Yeah.
he's also
Hmm.
very famous just for creating
Yes. Yeah.
value.
I know
Yeah,
him. Yeah. Yeah.
yeah. Super
Hmm.
famous and super
Yeah.
nice. I got to meet him in person.
Okay.
But like most people, I met Yona online first. And yeah, he just has a great personality. It just comes across. If you care about other people, you enjoy creating value, then you can build an amazing following, and he has.
Yeah.
Well, somebody in the group said, "Hey, have you ever done a syndication? Have you ever raised capital?" Well, I said no, but I sure would like to try.
Hmm.
And the reason I think they were willing to give me a chance, a couple of things. First of all, I was an apartment owner, so I had some credibility there. And then at the same time, uh, it was a deal that needed a lot of capital raise. This was a loan assumption. And as I
Okay.
remember, I think we got into it at 3.65%. And this
Hmm.
was 2021. So maybe that was not, it was late 2021. Maybe that was not too crazy. But, the loan was good. It was agency debt. It made sense. But the property had appreciated, and so that creates a little bit of a problem. It means you've got to bring more capital to the table. So it
Yeah.
was a good operating group. It was a good deal, but it was still a very hard capital raise. Even though raising capital at that time, and people talk about raising capital now,
Yeah.
they would do probably anything to be back in the 2021 environment. But yeah, we had to bring a lot of capital to the table, so they were willing to accept somebody who had never raised capital before. So that
Hmm.
was the thin edge of the wedge. And then that group that I described earlier, which I called a mastermind group, Horizon Multifamily, which we still work
Hmm.
together on various projects.
Hmm.
That group, one of the members brought us a deal and said, hey, would you like to join this? And so I was able to raise a little capital for that and do some other things on that other deal. So I actually ended up getting into my first two syndications in the same month of 2021. So it all just came
Hmm.
together at once. So I
How
got to
hard
be a
was it to
co-GP.
raise the capital for the first time? Like,
Yeah, not easy because I didn't
hmm.
have a huge network. I mean, I was probably up to 3,000 on LinkedIn. Now I've got over 5,000 followers.
Okay.
But it's not so easy the first time out.
Yeah.
But in both cases, there were experienced syndicators on the team. And as you mentioned, partner up. Now, for the JV deal,
Mhm.
we were all real estate investors, but none of us were commercial real estate investors. So we didn't really partner up, but we did partner together. But
Yeah.
this other two deals would be an example of partnering up to be a smaller part of a bigger deal with a bigger partner whose track record you can point to and you can say, listen, this is why I know this deal is going to go well, because this operator has done it before and they can do it again.
Yep, that's right. So now moving forward, right? What's your strategy to build investors relationship? Like, how do you get more investors to come to you, looking for good deals from you?
So for me, I decided, oh gosh, well over a year ago to focus on authorship because that's one of the things that can truly differentiate you. Now, a lot of people have a loss leader. Some people even write a book and call it a loss leader. I've read many of those books and they look like loss leaders. But I decided to actually write up my true story, how I was a tech guy who
Mhm.
enjoyed his job, who got a lot of money for what he did. I even got a lot of vacation time over the last few years, and that was nice. But who discovered that through entrepreneurship and passive investing, I could have a much different life. Now, I would say with entrepreneurship, you can have as much freedom as you're willing to work from dawn to dusk for. So it's a freedom of sorts. But with passive investing, it actually is true freedom. And as over the years, through my tech salary and through various things that I've done, active investments, etc., when things like that exit, I have been able to build up a significant passive nest egg. And I thought that that was really the most compelling story that I had to bring to people. That I've gotten to a certain point in my life where, yes, I do work like a dog about half the time by choice. And the other half of the time, I can say, listen, there's only so much work that I have to do on these active investments. And I'm just going to go out and enjoy. I'm going to spend my time with a family, learn Argentine tango, got in the best shape of my life, have
Yeah.
time for my instruments again. This is, I think, where people want to be. And so that was a story I told in my book.
And in addition to the book, like any specific process or strategies you put in place so that you create an investors funnel and attract more investors.
Probably the best thing is my weekly call. So I got a weekly
Okay.
Zoom call, and when people, sign up for that, you have the opportunity then to hear about deals and other such things. So over
Mhm.
the years, I realized what a gold mine that is. I'm over 1,000 email addresses. So that emailing, there's many ways you can build it up. So you can
Mhm.
you can do it by, some sort of a lead magnet on your website. And I have a different book not released on Amazon yet, but you get a free chapter of that. That got me some email addresses. Going
Mhm.
on podcasts, having my own podcast gets people to
Mhm.
my website. But really, that weekly call more than anything, that's introduced me to the people. It gives me the network that I can put the deals together, and it's also given me the funnel that I have limited partners to market to as well.
Mhm. And this weekly call, like, is it like a weekly
Yeah,
mastermind
weekly
call or
weekly
what?
Zoom. So we
Okay.
do talk about special topics. Something
Okay.
will come up because there's always something going on in the
Mhm.
world.
Okay.
Um, my gosh, I wish I could give you a great example, but lately, but whether it's interest rates or insurance in Florida, there's always something to talk about.
Something.
But
Yeah.
really, I would say this is the no muss, no fuss, no fluff. Just get down and dirty with networking. I've got a friend. He says, do deals or make friends, do deals, become wealthy. And I sort of took that for my own with this call and with my events. Dan Lukowitz, he's always out talking about triple net. Going to speak at one of my events this upcoming week. So, he's been very influential to me. And I think that really is the philosophy.
Yeah.
Get out there, meet people, learn what's going on. It's not just about networking. It's not just about grabbing 10 business cards at an event. Find one person that you can actually partner with, whether it's a limited partner who wants to invest in your deal, whether it's an active operator, you want to invest in their deal. Because whether I invest actively or passively, I learn something from every single deal I'm a part of. Or whether, for example, it's a lender. I've
Yeah.
found a local lender at my last local meetup that I ran. She can get me 12% plus 1 point. She'll take a point on the intake. And for my money, that's a good deal. Again, I don't want to be the one who has to say no to 100 deals. A little different with fix and flip. You don't have to say no
Mhm.
100
Yeah.
times, but I'd rather look at something that an experienced investor has already done. And so there you go. So it's for me, it's all about networking, but networking the right way. Find one person in the room that you would actually do a deal with, and then establish a relationship. Go and have lunch with them, learn what they know, figure out how you can contribute to them, and then that's how you get value in return.
Yeah. Love it. Love it. All right. The other thing is like, in you have been in real estate for quite some time, so I'm pretty much sure you might have come across any tough situation or challenging situation, right? Any one of them that you like to tell to our listeners, uh, what was that and how did you overcome it?
Yeah, sure. Like even the first deal was very good, but we dealt with the interest rates going up faster than expected. Construction took longer than expected. So did we refinance at 3 or 4%? No.
Yeah.
But because we had a solid margin of safety, we doubled our rents because they were under market to begin with, and because we made extraordinary improvements. I mean, going from pest control issues with, there was a rat in one unit and cockroaches in others, to now that this is literally, in terms of the interior, one of the nicest units you can stay in this neighborhood. Yeah, we more than survived it. We're thriving, and when the interest rates come down, we're going to have a second refinance, and this one should provide the payday that was expected. But I think that's really the lesson I would say is that every pro forma is only if there's not a cloud in the sky and the sun shines every day. That you will always, always, always have problems with deals. I mean, I could talk about other things like redevelopment. That's always an issue. It's always harder than expected because you've already got a structure. And you
Mhm.
may think that you have some verbal agreement with a city that you don't have to replace all this, that'll be grandfathered in. They sure talk the talk when they're courting you. But when you're in the relationship, when you're married, after you go to the altar, you may find that you didn't make the deal with the city that you thought you did. And then you open up the walls, and as they say on those home improvement shows, oh, the cost just went up. So then you also find these surprises. So redevelopment I found is it's very difficult because it has a lot of the complexity of ground up development, and at the same time you have some surprises that you wouldn't have with the ground up development. You have to do everything when
Yeah.
it's ground up, but you may not think you have to replace the fire system. Or you may have, a regulation that you need 3/8 piping for the sprinklers. But then they change it to a half inch and it hasn't been inspected yet, and they make you rip it out. So redevelopment
That's
is
true.
hard.
Yeah.
Yeah.
So we
So
have
true
been in
stories.
Gao.
I'm not
Yeah.
making this
So
up.
yeah. So no, I totally agree with you because we are in ground up construction. We build luxury single family spec homes here in New Jersey, as well as small
Yeah.
multifamily properties.
Yeah.
So we do ground up construction. It's a lot more easier than tearing down the walls and, you know, uh, putting a new electrical plumbing systems together uh,
Yeah.
in the existing building. So because we know exactly what needs to be done. There's no surprises. We yeah.
Exactly. Yeah.
Yeah.
Very true. Yeah. Great, great business to be in. Like I said, families in construction.
Mhm.
Love it.
All right. Hey, George, like, how do you see the real estate landscape evolving in the future, right? In next few years, like especially now where, the rates are coming down, but the mortgage rates, the Fed rates are coming down, but the mortgage rates are still up high. And so what do you see about this scenario?
I'm glad you mentioned that because I think that that is a bit of a conundrum for many investors. And this is where I would say that you really need to understand the business end of what you're doing. Now, if you're out there raising capital, whether as you are, you're focused on ground up construction, or whether you're focused on value add or something of that nature, we're really where finance meets real estate. This is really at the
Yeah.
nexus of the two. You got to understand the finance, and so I'd love to dive into that. So why is that? When the underlying rates go down, right? When the Fed cuts rates, they cut the target rate. You would expect that the bond prices are going to follow. But what's happening is that the stock market has just gone on such a tear that people are not, they're not investing in bonds. They're not seeing that as necessarily a great investment, although you should see some capital appreciation when the interest rates go down, and they will. But we got to remember at the end of the day, we talk all about the Federal Reserve. But at the end of the day, it really is a free market, at least a free
Mhm.
market of sorts. And so if the investors don't follow suit and they don't think that it's worthwhile to go and invest in these mortgage-backed securities, then it's really, we're really not going to see the market follow the Fed. And yeah, of course, with mortgage-backed securities, we have one other element of prepayment.
Yeah.
And so when they do prepay, ouch, that's bad news. So whereas for an ordinary bond, um, it's a nice thing to see the interest rates go down because you get some capital appreciation, and you already locked in your coupon.
Yeah.
For the mortgage-backed security investors, no,
Hmm.
not so much. It's the
Yeah.
opposite.
And the thing is, because as you mentioned, like the stock market is on the tear, so most of the people are more inclined to invest their money in the stocks rather than in the bonds, and just keeping it,
Yeah.
uh, the
Yeah, well,
spread.
2 years of
Yeah.
20% plus appreciation in the stock market. I mean, if I had a
Yeah.
crystal ball, I wouldn't have worked at all over the last 2 years. I would have just picked
Yeah.
stocks.
Yeah.
But I think that speaks to the importance of diversification. You have to be liquid. So we should
Yeah.
always have some, I would always have some equity investments, and I do have cash positions, some of it in money market and some in treasuries. So, you always want to understand, like I said, I'm very big about staying in your lane. That's when you're operating. But when you're investing passively,
Mhm.
why not diversify? It's ridiculous to have all of your eggs in one basket.
Absolutely. All right. George, before we move to final round of questions, I can you give our listeners, I know you mentioned the book, but if you can give our listeners a little bit, just a brief summary of your book, what the book is about, what are the main topic it covers?
Yeah, sure. So I separated out into three pillars.
Uh-huh.
The idea is that you want to capitalize on hidden opportunities. For me, that's private markets. And that's
Mhm.
not just private equity, that's also private debt. I mean, like I said, loaning on fix and flips and things like that, or mezzanine debt. I mean, that's not so much for me. I
Yeah.
prefer first position. It can be a great way to go. So you want to invest where others are not looking.
Mhm.
And private markets, that's the way to do it. And the second pillar is take immediate and massive action. So often I think like I said, we go to an event, for example, you get a whole bunch of business cards, don't follow up. Total waste. Read a
Mhm.
book, don't implement a single suggestion. And research has shown, like if you don't implement something in a week, after going to, for example, a seminar, then forget about it. You probably never will. So whatever you do, you want to focus like crazy because life will get in the way. So whether it's, hey, I want to become a multifamily operator or whatever it may be, jump on it, jump on the opportunity, and make sure everything you do, whether it's reading a book, going to an event, follow up on at least one idea. And I would say do it before noon the next day. And then
Mhm.
the third is continuous qualitative improvement here. I don't know if you do the video from this, but
Ye-
actually, that's not as good as I thought. Never mind. Here, just look at the cover.
Yeah.
Continuous qualitative improvement. The other thing that I marvel at is that there are all these books on becoming wealthy. And so why don't they work? I mean, the whole society should be wealthy by now. And that's because I think that a lot of books just focus on, hey, this is what I did, follow me, I'm a guru. And I'm trying not to do that. I'm saying whatever you do, whether you follow my way, make your own way, some combination of the two, you're going to have to change who you are because when you change who you are, the world changes around you. And
Mhm.
so the third pillar and final pillar of the book is continuous qualitative improvement. Make sure that you are growing every day as part of your program, because if not, you're going to get the same results you always have.
That's true. If if you don't change, you'll have the same time that you had for past 5 years,
Yeah.
right?
Exactly. So that's why I put the passionate living out front. So that's the title of
Yeah,
the book, Passionate Living Through Passive Investing. I put that up front. Some people said you should put the passive investing first, but I feel like people have read through 100 books already, probably, because it's the same
yeah.
people that buy all of these
Mhm.
self-help, self-improvement, and wealth books. Is that this one's different? Make sure that you really are living larger every day of your life. Don't wait because it's going to make you a better investor. I'm a
Mhm.
better investor every day because I'll go down in the morning, I'll work out, I'll play my instruments, I will dance. I've got a dance floor in my basement. When I do these things, I remind myself that every minute that I spend scrolling social media it's not completely wasted just from my business, but that's a minute that I could have spent living life. So make sure you're living life every day because if it's just nose to the grindstone, it's all
Yeah,
too easy to get stuck in the minutia.
that's very true. Yep. All right, George, loving this conversation, but would like to get to the final round of questions. Are you ready?
I can't wait. Let's hit it.
All right. Okay. So the first one, which is the one book that had the most impact on your life or on your business?
First business book I ever read, still possibly one of the best, Seven Habits of Highly Effective People, Stephen Covey. He'll remind you, don't get stuck with what's
Hmm.
urgent. Focus on what's important and also sharpening the saw. That was possibly my favorite. If you remind yourself every day, it's that continuous qualitative improvement I'm talking about,
Hmm.
to make yourself stronger in one way, I guarantee that you'll see a different you in 30 days.
Okay. All right. What are your main source of information to learn and grow?
Wow. So many. I would say books I think are the best because when you think about what goes into a book and having done it, I will tell you, distilling your wisdom, whatever it may be, into those pages, it's better. And I say this as a podcaster myself. It's better than anything you're going to find on YouTube. Somebody sitting in front of a camera for 5 minutes, better than a podcast. Go find those books, read them. But again, read them to find a few great ideas. Okay, you'll
Yeah.
find fluff in 100 pages,
Yeah.
but what are the three ideas that are new to you or which you haven't implemented yet? If you can get three things out of a book, it was worth the time to sit down and read it.
Yeah. And not only find it, implement it, right? That
Absolutely,
comes the
jump on
crucial
it,
part.
jump
Yeah,
on it,
jump on
jump
it.
on it.
Exactly. All right. What is the best business or investment advice you like to give to our listeners?
Yeah, I think you've got to understand, I mentioned it earlier, you simply must understand the business end of what you're doing. Real estate tends to be, I would say, a simpler type of a business. I would say it's not like starting an electric car company or space
Yeah.
exploration. What we're doing here is it's a bit simpler, but again, if you don't understand the accounting, if you don't fully understand the numbers of what you're doing, don't outsource that to somebody. I say everybody should be an underwriter. Underwrite every deal you're in, even if you're a passive investor. Know what you're doing because you have to remember. I think that it's not really so much about finding good deals. Remember, Warren Buffett says, "No called strikes in investing." If I say no to five deals that are pretty good, and four of them turn out to be great, I didn't lose anything, right? But
Yeah.
I would have lost a lot if I invested all five and the fifth one goes belly up. So, saying no to a good deal doesn't make you a bad investor. You need to work on making sure that you eliminate the losers from the portfolio.
Yeah. All right. Which is the one habit or routine that has been crucial to your success?
Oh gosh, I would have to say it's really continuous improvement.
Yeah.
Again, I feel like I'm repeating myself, but if you're growing every day, even if it's just, hey, today I'm going to go and work out, it means, you know what? You value yourself more than you did yesterday, and tomorrow you'll value your time more than you did today. And so that means that you're going to be more efficient. So yeah, just make sure that you're valuing yourself, growing, and being happy. Happy people are efficient. Unhappy people muddle through.
That's very true. All right, George, last question. How can Decoding Cashflow listeners get in touch with you?
So come to my website, www.robertscapitalenterprises.com. So just like my last name, Roberts with an S. Love to talk to you. I do love to spend time with new investors. If you got deals, or if you just want to learn what passive investing is all about, I still take all the calls. White glove treatment. If you work with me, you're not going to be shuffled off to some investor relation department. You work with a man himself.
Okay. Sounds great, man. George, it was a great show. Pleasure talking to you today, and we'll surely
Thank
stay in
you.
touch.
Thank you. I would love to. I greatly appreciate the opportunity, Ted. Thank you for having me on the show.
All right. Thank you.
Thanks for listening to Decoding Cashflow, brought to you by Aster Capital. If you found value in this episode, then please share it with someone who you think could benefit from it. And make sure to act on what you've learned. If you want Ted Patel to personally help you reach your goals, then feel free to set up a one-on-one call with him. Also, visit us at astercapital.com for more free resources. Content of this podcast is for informational purposes only. As always, please consult your own advisor before making any investment decisions or setting a course of action. Thanks again for joining us on this episode of Decoding Cashflow, and we'll catch you in the next episode.